Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Well, welcome back to another episode of the AAA Storage Podcast. I have with me, as always, the illustrious Paul Bennett. Thank you for joining. And I also have today on the show Logan Broyles, who is the Senior Market Analyst for AAA Storage. And today we're talking about how to underwrite a deal from the AAA Storage perspective. So there's a lot of data that needs to be surfaced, written down, analyzed, modeled out to get that go, no-go kind of perspective on each of these deals, the properties that are involved. And so, Paul, you'll be driving a lot of these questions. So I'll turn it over to you to introduce Logan and then and figure out, where does this process start?
Yep, super, Brandon. Thanks. Logan, super excited to have you on the podcast today. Tell everybody a little bit about your background. I know you're a proud Virginia Tech graduate, but particularly what you were doing when you made the transition to AAA Storage.
Yeah, absolutely. Appreciate the introduction, Brandon and Paul. So my background is in due diligence and feasibility, specifically in the self-storage asset class. And I know obviously here at AAA Storage, the focus being self-storage and industrial flex space. My experience, while focused in self-storage, did have some involvement in that industrial asset class as well. But really working with hundreds of developers nationwide to really assess their properties and provide a thorough due diligence process to help them to assess an opportunity. That's market dynamics, looking at the market dynamics, and then pivoting from there to quantifying the demand in a given market from a supply and demand standpoint, and then helping that inform where we're at with putting together a financial pro forma and financial underwriting. Is really kind of I kind of think of it as a three-step process. That's really how I've gone about it, and worked with, like I said, hundreds of developers, and have visited most of those projects and visited those sites and seen those markets, and had those discussions, and that's really kind of what my world has kind of been the last number of years prior to being with AAA.
Yeah, and we're like I said, we're really glad to have you on board. You've brought a very not different, but very broad perspective. You only know what you know, right? And so when somebody comes in from outside with your kind of experience, you brought a whole different perspective on the process of really doing due diligence and feasibility on these projects. So the process starts, Logan, as we talk about, at different points in the podcast that we've done over the months. We really underwrite a project twice. We underwrite it when we buy the land, particularly at the market level, which is your true expertise. And then a second underwriting is done 2 years or so later when the project is actually designed and we have all the cost data and everything else, and we're making a true investment decision. But because we land bank the land, initially we're buying that land and going to hold that land and get it entitled for a future investment. But in that first stage, the first step in the process is really defining what the market is. Can you talk about that for just a minute? And what does that look like? And what kind of factors might influence how you define the market? Is it 3 miles, 5 miles, 8 miles? Is it shaped like a pear? Is it shaped like a circle? What are the kind of things that you look at when you're trying to define the market?
Yeah, it's a great question. So, and really, once we have identified where that piece of dirt lies, we want to define that market, and that informs everything else that we're going to do. So the two things that I look at to help define that market, generally for self-storage, it's going to be somewhere between 3 to 5 mile radius, but there are certain situations where that's not the case. Maybe it's beyond that. Maybe it's a more rural market. In a super urban market, you might have a smaller radius. There's things to consider like natural barriers, lakes, rivers, mountains, oceans, whatever the case may be. Some certain types of segmentation where you may have a dynamic that exists where folks may not travel to a certain side of the tracks because of this is just where everybody does their shopping, and or maybe it's drive times and the way that the interstate system is laid out in that given market. There's a lot of different variables to consider, but the two things that I really look at are population density and number of quality competitors. Those two metrics specifically are to be taken into account first and foremost when you define that market. I gave mention to earlier there being a market where there's a lot of growth within a 3-mile radius, but there's less than 20,000 people. That's not a lot of folks in a 3-mile radius. So you probably need to cast a wider net and really expand that market. And obviously once we've kind of considered that and taken both of those two pieces into account, we can then confidently say this is our market, and then dive into exploring all of the other dynamics there from that point.
Yeah. Super. Yeah, it's a critical first step in defining that market, because it does, like you said, it drives everything else that you do from that standpoint and the data that you're generating and the analytic process. You mentioned not only population growth, but the number of people that live within that hyperlocal market. Talk about that for a second, because we've run into a couple situations where the growth numbers look great, but it was starting from a fairly small population, which can be problematic, right? Because only a certain segment of that population is going to use storage.
Right. Yeah, absolutely, Paul. And there's a market that we've looked at recently where, there's very strong growth numbers in that market. But it's got less than half of any of the other property, less than half of the population total currently than any other property that we've looked at recently. So that's really a red flag that jumps out to me and kind of weights that specific variable in a much greater manner than the other variables in play because of that, because you just don't have a lot of people. 5% growth on 10,000 people is a lot different than 5% growth on 50,000, obviously. So yeah.
Exactly. Yeah, that's super. I'm trying to think about how to help people really walk through this. We actually underwrite a project multiple times. We've talked about on the podcast before that we land bank land. We buy land and then go through the entitlement and project design process. So talk a little bit about that in terms of what you're looking at when we're looking at to purchase a piece of land versus what we're looking at when we're truly underwriting a specific self-storage project that's been designed, has construction costs. There's a little bit of difference. We don't do full pro formas at the point we're doing the initial land acquisition, because there's a lot of unknowns at that point. We don't know what the project is going to look like. We don't know how many square feet, that type of thing. Can you talk about sort of the two-step underwriting that usually occurs? We underwrite it when we buy the land to make sure it's a good market and good location, which is really your focus and expertise. And then we underwrite it a second time before we allow it to go into one of the investment vehicles to make sure that that market dynamic hasn't changed significantly and that the project pencils from a financial standpoint.
Yeah, for sure. You nailed it. And as far as the dynamics, obviously every market dynamic is changing. It's as we're kind of coming out of here currently, kind of a lull a little bit in the market, and kind of seeing some rental rates ticking upwards, occupancies maybe ticking upwards a little bit, and I think that trend may continue. But obviously, market dynamics change over time, and that's something that we want to make sure that we're capturing. And that's obviously the reason for underwriting that multiple times and making sure we're as dialed in as possible.
Yeah. What are the major components? You sort of ran through them quickly, but let's just hit the critical components of supply and demand that you look at, and where do you get that data? How do you generate that data?
Yeah, it's a good question. So a couple things here. So we want to look at really at the core of what we're trying to do with our market analysis and then suit the financial underwriting is quantify demand in the market. Once we have an understanding of that, we can then move forward and project what those financials look like. And in order to be able to quantify that demand in the market, we look at really three, I think, major things. There's some other variables, but three core things, and that's occupancies of existing stores, rental rates at those facilities, and then the percentage of of households in a given market that are using self-storage. What does that usage look like? Those are really the three things that we key into to discern where demand is at in the market. Obviously, there's other market variables that we look at in terms of competitor rates, potential new supply coming in, demographic growth, all of those pieces. But those are really the three demand drivers, if you will, or demand indicators rather, of what that looks like.
You hit two really important things there I want you to expand on just a little bit. You talked about the utilization in that market. One of the key things we've talked about in other episodes is that we look at square foot per capita. In other words, how many square feet of storage exist in that hyperlocal market per capita. And typically, most people will tell you in the industry that anything below 10 is an acceptable level of supply in the market. Once you get north of 10, you better be in a pretty good growth market or have some other dynamics in play. But you actually look at it a little bit differently. Talk about the difference in utilization in a given market. And I'm kind of leading you here, but I know because of our conversations on a day-to-day basis that you can look at the amount of storage that is rented in a given market versus that population and determine that. I'm going to make up an example. For example, in a military town, utilization of storage may be closer to 15 to 18 square feet per capita because of the unique nature of that market. Talk about how you sort of dive into that, because I think it's an important nuance. We don't just look at square foot per capita and use a standard 10-foot sort of cutoff. It is really a little bit more informed than that in terms of how you dig deeper into the data.
Right. Yeah, absolutely. So square foot per capita, it's an interesting metric. A lot of folks talk about it in the industry. The way that I look at it is, it's we're trying to quantify demand. But square foot per capita, it tells us nothing about demand. Really, it's a supply side metric. And as we know, different markets absorb supply differently at different rates. Like you mentioned, in your example, a military town that may be that square foot per capita may be higher and ideal, or in theory less favorable. But that may not be the case because it absorbs it at a higher level. I use the kind of the silly example of there's probably more cowboy hats sold in Texas than there are in Connecticut.
Probably true.
But there's that number being low in Connecticut doesn't necessarily mean that market can absorb a ton of more cowboy hats. It's just, some markets absorb differently, and we need to take that into account and not just use, a metric across the board and just assume that markets are going to absorb it at the same rate. So,
yeah. And it can cause you to miss an opportunity, or it can cause you to step in a hole. Because if you're sort of basing your analysis on 10 square feet per capita, and the reality is usage in that particular market, for whatever reason, is sort of below the norm on a national average basis, you can step into a market that won't perform. You mentioned something else. Where do you get your data on pipeline deals? And how do you sort of really scrub it and confirm it? Because that's another thing that you have to really be sensitive to, which is the market may look great today, but there may be 6 new facilities within 5 or 6 miles of the site you're looking at that are on the planning board or coming out of the ground, and that market can change in 6 months to a year pretty dramatically. So talk about how you gauge new supply and how you really make sure that we have an accurate view of what the new supply coming online in that market is.
Yeah, absolutely. One piece that I dive into is kind of at a deeper level. So first, I guess starting first of all, we use some of the different software platforms out there that are informative, specific to the self-storage product. So those are helpful, but they're not always 100% accurate. But they are helpful in kind of setting that initial picture of what a given market looks like. To take a deeper dive and really kind of get an understanding of what's taking place in a given market, we reach out to local planning office and try to confirm and get specific information about a given project, size of a project, status, where it's at in the pipeline. Is it moving forward? Is it not? When is it expected to enter the market? Distance from our site to that project, and is it really a threat? Is it kind of a different submarket? What does that look like? and how does that all affect what we're doing? If there's an influx of a lot of new supply coming in, that you run the risk of prolonged lease up and softened rental rates. So that's really obviously the main concern that we want to try to account for and accurately forecast for.
Yeah.
So amazing.
At the end of the day, when you really understand the demand side of the equation, and you've determined that the market can support another self-storage facility, how does that data sort of talk about for a minute how you work with our financial analyst and what your role is in producing the ultimate financial model that drives the real investment decision from our standpoint?
Which clearly has to have 100 tabs because of the amount of data that you guys are looking at right now. It's amazing.
I will tell you this. We just did an investment committee meeting, sort of doing another review of the Fund 2 properties. And just the market analysis that Logan generated on those 11 properties was 125 pages of data.
Oh my gosh. Okay, well, I'm glad there's
we're
people
only,
like you doing this.
I promise you, we're
don't
only
do this.
scratching the surface on the sort of all the different perspectives and data that Logan generates to really come
Amazing.
up with as complete a picture as is humanly possible. Nobody can predict the future, but
Right.
But talk about, Logan, how that translates. So you've done the market analysis. You've determined the supply and demand balance. You understand the rate environment in terms of what rates we can charge in a given market. And all of that then is used to talk about how you coordinate with our financial analyst and your role in generating the financial projections that ultimately really make or break the investment decision, go or no go. Does it meet our criteria?
Yeah, absolutely. And putting together, really the way that I look at it, kind of and mentally I approach it is, you have the market definition. Really, definition of the market's the first piece, and then obviously the market dynamics that kind of come ensuingly with that. Rates, new supply, things we've already discussed here, and then looking at that demand, where's that demand level in the market? Is the market oversupplied? Is it undersupplied? Is it near equilibrium? Is it trending toward equilibrium? What is the case there? And then from that, that informs what we feel like is realistic to project and forecast with the financial underwriting there. And really, the lease up model, that's a big part of what I've been involved in the financial underwriting piece. And, the speed, the velocity of lease up. We generally at AAA will do a phased approach. And looking at, once we get to a certain threshold with occupancy, looking at going with an additional phase. So taking that into account, those are all factors that I've been kind of living in and considering what is realistic to expect, going forward with obviously an ever changing market. So that's a big piece of it.
Yeah, the financial modeling piece, which is ultimately, again, what decides whether it's an appropriate investment for our investors or not, really involves 3 or 4 different groups. First of all, the market data that you generate is what's used to drive rates and lease-up velocity. In other words, time. How long does it take to get that first phase leased up to 65 or 70%? Before we build phase 2, how long is it going to take once we get phase 2 built to stabilize that whole project? But you also have inputs from our construction and development team because they're the ones that have done the actual project design and CapEx budget to build the project. David Lutz, our VP of Property Management, gets involved because he's really looking at the expense side of the equation and working with you on the revenue projection side because he's the one that ultimately has to deliver that result. So you just got to be comfortable with that. And so you've got all these inputs that come together that ultimately create a P&L, a forecast. And at the end of the day, time is what's really important, right? You get a whole different return profile if a project if you project it to lease up in 4 and it takes 6. That's a whole different outcome. And obviously, we don't control every aspect of it, and we don't have a crystal ball. But you've done a pretty good job if you look at the projects that are in flight now in Fund 1 at we're pretty much hitting our marks in terms of what we projected and what we expected, and that's the result of really solid underwriting on your part. There was a question in there somewhere, and I don't know where I lost it along the way, but that happens sometimes, right?
Happens to us all. Maybe you got some more setup, but I'm curious too of thinking from the investor's perspective. So as an outsider, so I do want to get there at some point in the conversation of just like, you go through this whole process, you work on the analysis, you build the model, working with an analyst, and it goes to an investment committee. You guys kind of give the green light, red light kind of thing, and then there's ultimately information that's presented to the investor. And so I'm curious how that dynamic takes place, and almost like how is this process serving the investor at the end of the day, and getting their making sure they're getting the returns that are hoped for and that sort of thing. So that's kind of where my mind's going. But Paul, you might have some something to jump in before that.
No, Logan, take a crack.
Yeah, I can speak to that. As far as the investment committee, that's something that we do internally. We get a property come to me, and I'll do that initial what I call sniff test, and just kind of vet it at a high level and look at any red flags, and if it seems to check out initially, I'll engage our construction department and kind of get their viewpoint and their perspective on it. And then we will, if we think that it makes sense, we'll bring it to. We have a monthly investment committee meeting to present and discuss any potential new acquisition for self-storage or industrial flex space. So
have folks read that? Like, is that committee, they've read that 125-page report essentially, or you got a couple of them that you guys are peering through, and that takes obviously a lot of time to sit down and read that.
Right.
Works?
And so the lengthy report that Paul had mentioned, that's more that's not one single property. That's our whole fund. Overview. Okay. So that's not every property, to be clear. Okay. But so we'll move forward and set up that investment committee on a monthly basis and review any properties that we have to discuss. We have the actual, the committee that we have internally is made up of 3 individuals. Paul is on that committee, and they will review that presentation that we put together, both from the financial perspective, market perspective, as well as construction viewpoint, and consider, is this something that makes sense for the group to take on. So that's really kind of the process at a high level of what we do with the properties.
So Paul, you and your team would be kind of like the red team, blue team kind of thing. Like you're poking holes at the model and kind of the projections, maybe things like that.
Yeah, and it does occur. I said this at the beginning, but it occurs at 2 different stages. The way we look at land when we're buying land, because we're spending our own capital to buy this land and land bank it for a future fund, is a little bit different than the way we look at a complete investment opportunity on behalf of one of the funds. Because at that point, like I said, the project's not designed. We don't have exact cost information. We can't look at yield on cost or internal rates of return to investors, because we're looking at a piece of land that we've just seen for the first time. So we really, really lean into Logan's expertise at that stage, because the only question we can answer is this a market we want to be in or not? Okay. And so once that decision is made, the land is bought, and then it goes through a 2-year process. Our architectural team is doing the design work on the project. We engage a civil engineer to do the site design. The construction department is costing out the project. All of that goes on during a 2-year period. And then it comes back to the investment committee as a complete investment. So now we have all the data. We've got Logan's updated market data. We've got all the construction costs. We've got, at that point, maybe we've got at least a preliminary proposal on a loan. If not, we've made some assumptions about, debt and what the terms will be. But we have a really complete picture. And at that point, Logan's market data has driven and informed the financial model. He's worked closely with the analyst. And what comes out of that is we're able to look at yield on cost. Does this project meet our 9.5% yield on cost hurdle or not on an untrended basis? We can see cash flows, how much working capital, how much total capital, not just CapEx, but CapEx and working capital is that project going to to need. Based on Logan's rate projections and lease-up velocity, we can see the point at which we project it to stabilize. And at that point, the model projects a sale. Logan's influential in what the cap rate is used, what cap rate is used to drive that sale. And then we see the sale result, and we can see an internal rate of return on the project. And we calculate that rate of return on a gross basis and on a net basis to the investor. So we can, all the way through that, the second underwriting process is all driven by the work that Logan does, but it adds on top of it all the different departments. The investment committee is comprised of John Muick, my partner, myself, and Andy Muick, which is basically our board of directors. Everybody, every department head in our organization participates in that meeting because Logan is there to speak to the market data. David Lutz is there to speak to the market along with Logan, as well as any property management issues. Sean Beekler, our director of development and construction, is there to talk about the assumptions in their costing and what, if any, challenges they see and that type of thing. So we have all of that input into one event focused on a property to determine whether this is the right investment to make or not. And I know I'm sort of hogging Logan's time here, but you asked the question, why is that important to an investor?
Yeah.
First of all, I've said this 100 times, we're the largest investor in any of our investment vehicles. So we're looking at it from, is this something we want to invest in? Secondly, it's the critical stage. If you don't have it right from the beginning, then the probability of the outcome you're expecting isn't very high. And so this is the underwriting is the critical step, and good judgment and lots of data and a good, solid, robust process is critical to it's what's driven our track record for 30 years. And we've actually made the process more robust in the last 12 to 18 months. What?
I said no pressure on Logan's part. That's we're
Logan has been such a huge addition to our team. His level of expertise. Logan spent 5+ years before he joined us as a consultant to developers around the country doing feasibility studies for self-storage and industrial projects. So he brought a whole different process and different viewpoint to that process, and he's been extraordinary. Logan, talk for a minute, real quickly. You have a range of factors. I can't remember how many it is, but you probably know at least close how many total factors. And then you weight those factors so that you have a weighted result. And so when Logan does an initial assessment of a property, he has, 10, 12 factors that he thinks are important and we think are important. And then he weights those so that you basically wind up with a score. Talk about that for a second.
Yeah, absolutely. So, some of those factors may be, market focused, things like, we like to look at specifically on the rental rate side, like a 10 by 10 climate controlled unit. A very popular unit size. Most facilities will have, a good number of those available. So really, where is that unit at in a given market? That's a good barometer on where rents may be. That's one metric. I mentioned population, the quantity of population, but also in addition to that, the population growth. What does that look like? And kind of getting back to my comment earlier about a property that seeing large growth numbers, but not having the numbers there presently. Obviously, that's something that plays into it. So those are a couple of things. Things like obviously land cost. That's a critical metric that we would obviously evaluate from the outset. But those are some of the high level things that we would look at when assessing a property initially. Other things would be new supply coming in. We look at it from the way I like to view it is what from a percentage standpoint, how much is the market expanding by that new supply coming in. This is what we have today. If there's 100,000, we have a 500,000 square feet net rentable square feet in a given market today. They're building 100,000 net rentable that's going to be added in the next 3 to 4 months. That obviously is a market expansion of what's that? 20%. So Obviously that's critical. 20%. I would say anything beyond a 20% expansion in a market from a market standpoint in supply is significant, and that's something that we should certainly take into account. There's some markets where I see it, you talk about red flags. If you're 50% market expansion, that's a major red flag to me, because that's a lot of new supply coming in, and the market has to absorb that, and it's going to, take a period of time. So those are things that I like to look at. In addition, one thing I hadn't touched on, just specific market variables, distance, proximity to other competitors in the market. If there's a little bit of a hole in a market, that's something that's interesting, that can create a kind of a unique dynamic. Maybe there's a lot of strong competitors, but you may have maybe it's a 2 or 2.5 mile gap between where your site is to the closest competitor. That's something we want to identify. And also too, speaking specifically about those competitors, like to look at how many of them are REIT competitors, national big players on the national scene. That's something to take into consideration, is oftentimes, as we've seen here in the last probably 2 years or so, some of the pricing, approach to some of the pricing games that some of those operators take is a little bit different than maybe some of your regional or local operators. So that's something to key into, as well as how many, of those competitors in the market are national REITs. So those are some of the things that I look at. There's probably some others, but hopefully that kind of gives you a high level of some of those metrics, and how, like Paul said, some of them are weighted more so than others. Like the one market that I mentioned, just, a lot of favorable metrics specific to that given market. But just the fact that there was not, hardly anybody there, it really kind of trumped everything else. So yeah, definitely weighting those metrics accordingly. And, each one is to be taken and considered independent of each other, obviously.
Yeah. Super. That's a really good explanation, Logan. Brandon, as you can see, this process is a lot of science and a little bit of art. There's a little bit of art in here, because there's so many different things to consider, even when you look at these very concrete parameters and checkpoints that Logan uses. We, in the investment committee, we were talking about a piece of property that really did not have sufficient population on the surface, but when it also had almost 30,000 cars a day passing in front of it, and it was in between a major employment area and the bedroom communities that were feeding those employers. And so what you had is, this wasn't 30,000 cars a day that were on their way to California. Property happened to be in Texas. This was 30,000 cars a day that were going from their home to work, and they passed that facility every day. Something like that can actually change your view of whether that property has a chance to be successful or not. So anyway,
they say, like, looking at a financial
enough,
model or a 10K, the story really is in the footnotes. Those details are actually really key.
Yeah. And so at the end of the day, Logan's process really informs the financial models, particularly from a lease-up velocity and timing standpoint, rate standpoint. And like I said, we're super thankful to have him on board. He's been a great addition to the team. And thanks for doing this today, Logan. I know you've got a lot on your plate right now, so.
Yeah, absolutely. This has been a pleasure. This is really kind of a step outside of, I guess, my day-to-day and to be a part of this. But hopefully this has been insightful, and I've enjoyed it.
Yeah,
we're grateful to have you on the show. Thank you. And I'm really grateful for your work, really. I mean, this, like, to Paul's point, your work is what helps create that kind of track record that you guys have had for so long. So appreciate you, and I know your investors are too. Well, we will see you on the next episode. Thanks so much for joining. We'll see you.
Okay, guys. Thanks.